What's up, everybody? This is Lamine from investingsimplified.net. Welcome to our weekly macro for the week ended 5/28/2021. Today, we will take a look at our two key macro indicators. We will take a look at the ES Weekly NQ, and we will wrap up the review with earnings update. So with that, stay tuned for more detail. Looking at the weekly time scale of the dollar index, this is one of our key macro indicators that we monitor. Looking at the market structure, it's a clear trading range since 2015 to about now, almost 6 years. Dollar index has been trading between 88, lower 88 range to about 100.5. This breakout here was a bull trap. Market broke out but didn't last. It rolled over, came back. This was another bull trap. Market broke out for 1 week, rolled over. We understand that the consensus trade on the dollar going into 2021 was dollar going lower. Thus far, that has played out. But we are a little bit cautious here. The reason for that, looking at this falling wedge, market broke out, but the breakout didn't last too long. We roll over again and we are forming another wedge. And the reason why we are a little bit cautious on everybody thinking the dollar is going to break this key support level, one is the indicators. Although we use indicators as confirmation purposes, not for timing tool or anything. But if we compare this low in August of 2020 to the most recent low back in January, as you can see, this was a lower low. But indicators, MACD basically made equal lows, RSI made higher low, which indicated to us that this move to the downside was exhausted and it was testing a key support level, which led to a short-term bounce, and market is rolling back over again and we are forming another wedge. The question remains, is the indicators going to roll over? If market breaks here to this key support level, is the indicators going to confirm? It remains to be seen. We will monitor. And the reason why we are a little bit optimistic or patiently waiting if market is going to find support here is, think about this falling wedge here too, from end of 2016 to about 2018. What did market do? Lower low, indicators did not confirm the move, which indicated to us that this move was exhausted to the downside. When we broke out, market rallied, retested prior high. So RSI made lower high, higher low, MACD made higher low, price went back up. It's the same scenario going to play out here. We don't know. It remains to be seen. We will continue to monitor. We just want everybody to be cautious that just because Wall Street consensus believe dollar is going to go lower, we don't know if that's going to be the case. However, we are monitoring this key support. If we see any qualified and confirmed break here, yes, it remain negative on the dollar, but at the current level, we are just monitoring any break. If it is not confirmed by indicators, we will not immediately short. Our strategy would be wait for the dollar to break down, rebound, possibly test this prior support level, which will turn into a resistance, and then that will be the best opportunity to go short and expect dollar to continue to go low. If we just want to short the breakdown here, think about this. We broke out, everybody sees this resistance, say, okay, market is going up. It lasted for a few weeks, market roll over. All those who purchased here got trapped. Again, it happened back in March 2020. We broke out for 1 week, market roll over. All those who purchased on this breakout here got trapped, market rollover, came back to support. So that's why we are cautious. We are optimistically cautious that if the support level holds, dollar could potentially rally here. And this market structure is a bearish structure, but if we break the upper trend line, we are off to the races based on what the indicators are telling us. So let's jump into TNX. Looking at the weekly time scale of the US 10-year notes, let's focus on the market structure from end of 2011 to about beginning of 2020 before this COVID meltdown. What do we see here? A clear trading range between 1.4 to about 3%. Market has been in that range for a period of time. As we can see here, this was a bull trap and market roll over, came back to the 1.4 level. Again, back in 2018, we broke out of the 3% range, but we only stayed there for a few weeks. Market trap, all the bulls around here roll over, came right back to the 1.4 level. So we have been trading between the 3% and the 1.4 for a period of time. Before the COVID crisis, we consolidated here for a few months. When COVID came, market roll over, we broke the 1.4% level, and that was the catalyst to the downside. Market eventually consolidated, found a bottom. In August of last year, we rallied. This didn't act as a resistance. The first week market market tested it, we broke through, and since we broke through, we started to consolidate, which was due to an overbought market condition. As we can see here, looking at my RSI. RSI at one point was almost at 83. Since this recent move, market consolidating with time, the question to us is, are we going to go towards this 1.95 level around the 2%, which is our upper end of the our target, or is market just going to consolidate here for a little bit longer, break below this 1.4 level again, and then ultimately go to zero? Remains to be seen. We will continue to monitor. Our base case is 10-year note probably will remain between the 2% and the 1.4 level, the 60 basis point trading range. Whenever we break above this 1.95 to 2% range, then we will reevaluate and see which asset classes will benefit from that and which asset classes will be impacted. However, if that does not happen, we do roll over and break this 1.4 level and we start to come down again, we will evaluate to determine which asset classes will be negatively impacted and which one will be positively impacted. Looking at MACD, MACD is on a sell signal for the past 3 weeks. We think there is a possibility for MACD to remain in a sell signal for a period of time until these overbought conditions work themselves out. As long as we don't get a break to the downside, break to the upside, see a choppy market for some time. Let's jump to the ES. This is the weekly time scale of the ES, the S&P 500 futures. For the past 6 weeks, market has not made much of a meaningful progress. We have been consolidating right around the key fib extension level, the 1618, measuring from this high to this low, the COVID meltdown. Market is currently testing the 4175 zone, which is the fib extension of this pullback. We believe that market have room to run towards 43 to 4500. Matter of fact, on 5/20/21, our internal model suggested to us, as market tested this middle trend line, to us that with a 70% probability the lows were in and S&P and other major indices should start to move higher. Since we made that call, and that video is on our YouTube channel, take a look at it if you haven't had the opportunity to look at it. Since we made the call, S&P increased about 3.5% and Nasdaq increased about 5.5%, and we still maintain that call. We believe that market has room to run here. Our strategy would be, once those targets get hit, whether it's around this trend line, which has been our upper end of the target, whenever those targets get reached, we will analyze the market structure to see if we should take our profit. If not outright buy puts, remains to be seen. This has been our strategy. We have been aggressive at any time market back away from the upper trend line, whether it tests the middle trend line or the bottom trend line. We increase risk. At any time market tests this upper trend line, we de-risk our portfolio. Looking at the indicators, MACD is pretty much sitting at a neutral zone. It's not telling us really anything here. We'll just need to pay attention if it's going to generate a sell signal at some point. RSI is not overbought, sitting right around 69. So once our targets get reached, depending on what the indicators are telling us, we will analyze the market to let our viewers know. With that, let's jump to NQ and see where the key levels are. Looking at NQ, this is the Nasdaq 100 futures. Looking at the market structure, clearly bullish. We don't see any bearishness in this chart at all. Our strategy, as we discussed when we are looking at the ES weekly time scale, de-risk as market tests the upper trend line and be aggressive as we approach the lower trend line. Since the lows were identified by our internal models on 5/19/21, we believe NQ should make progress towards 15,000 as well as S&P approaches 43 to 4500. This is our strategy and we have no interest shorting the market at this level. However, once our targets get reached, we will definitely analyze, understand what the market structure is, if we should take our profit, if not outright buy puts or put on some bearish strategies that will benefit the portfolio going forward. That will be our strategy, but we will analyze that once market reach our target. NQ, we have a little bit of a concern about NQ indicators compared to S&P 500. Let's bring your attention to the February highs of 2020, the COVID highs. If we compare that high to August of last year, as we can see, price made high, but RSI made a lower high. Again, in February of this year, when market made another new high, comparing August of last year's high to February of this year's high, both MACD and RSI made another lower peak, lower high, while price was making higher high. However, all of these higher highs this, while the indicators were making lower high, resulted to pullback. We had a decent pullback here for about 3 weeks. There was a decent pullback here. Situation, market made new highs. We just recently got another pullback here, and we believe market is on its way towards 15,000. Once those targets get reached, we will analyze the indicators to see if the indicators will negate this negative divergence between price and momentum. We don't think that will be the case. By the time it gets to 15,000, we don't believe MACD or RSI will make new high. And if the indicators do not see a market structure that indicated to us that market is about to roll over, we will definitely book a profit, if not outright buy puts or some bearish strategy that would benefit the portfolio. We will continue to play that until otherwise we see something different. With that, let's jump to the fundamentals. Fed and relevant headlines. Our fundamental thesis still remain in play. The 120 billion continue to go into the system. However, over the last few weeks, we noticed some Fed officials making headlines about tapering. How is that going to play out? We will continue to monitor the situation. Biden administration released their fiscal year 22 budget. They are calling for $6 trillion spending. Once that becomes a reality, we'll figure out which sectors will be the major beneficiaries so we can know how to allocate the portfolios accordingly. Let's take a look at the EPS and revenue growth. Based on where fiscal year 21 and the forward 4-quarter earnings closed at on Friday, it came at 189.61 for 21 and the forward 4-quarter at 190.94. The EPS growth increased a bit to 36% and the revenue growth at 13.5%. Based on those numbers and where S&P closed on Friday, the forward PE and the fiscal year 2021 PE ratio at 22 and 22.2. The trailing and the FY20, 26.3 and 30.1. These valuations are not really cheap, and it will be important to understand when we allocate cash into the market to be aware of where valuations are. Valuations are not timing tool. It indicates to us that we're at the current level, the forward returns would not be that great. And looking at the average PE ratio, if you look at the 20-year average, it's about 16.1. So which means we are about 1 or 2 standard deviation above the mean, which is really not cheap. Based on the valuation, we forecasted our year-end target, which we update on a weekly basis. Our base case for year-end for S&P 500 at 4,200 with a 65% probability, and bull case, if everything goes really great and we have some surprises, we could see the end of the year at 4,500. However, if things goes haywire, who knows? S&P could drop to 3,550 with a 15% probability. It's at 158. That's pretty much all we have for the numbers, and we hope that this helps. If it does, please hit like, subscribe to our YouTube channel so that YouTube can push this to more audience. We appreciate your time, and if you have any comment, please add us a comment, and please read the disclaimer. Nothing here stated is a recommendation to buy or sell any securities. Please take the time to read the entirety of the disclaimer. With that, we hope you all have a great weekend. Bye for now. Talk to you next week.